Welcome to International Finance. I am Andy Kim, your Dr. Finance. Now, this video we are going to go through the introduction part for options in FX market, right? The second video for chapter 7 of Un, Resnick, and Chulun's 9th edition. Now, currency options is the one we're going to discuss, right? And I told you before that this part of option, right, is perhaps the most mathematically involved throughout this book and throughout your the semester. Now, don't get spooked, right? We're going to go through the introductory part, right? To master all these things, in fact, you need to spend the whole year or more through some courses like major called financial engineering or financial mathematics, and then we are not going to go there, right? But we're going to gloss over those concepts briefly, and it goes back to our economics and then mathematics a bit. So we're going to spend some time in this video to talk about the introductory part, and then the next video we're going to discuss some mathematical and economical basics, right? And then the following video, we're going to go deeper into some of these options pricing framework, such as binomial option pricing, and then Black-Scholes, right? Risk neutral pricing, and that kind of things. Now, what are the jargons that you're going to meet? Well, call, put, long, short, and then currency option, currency futures options, and then such words like option is in the money, at the money, and out of the money, or no arbitrage conditions, and then hedge ratio, and then binomial option pricing. Those keywords will be there. Also, you will face some words like replicating portfolios, and then risk neutral probability. What do you mean risk neutral, right? Aren't we risk averse, right? We're going to use that concept here. And then Black-Scholes option pricing model. Whoa, that Nobel Prize winning Black-Scholes model, right? And then European, American, and Asian option. What? Asian option is also there? Yes, right? We're going to talk about, pretty much we're going to spend more time on European options, right? American option is like you have the right. European option is you can exercise that option at the end of maturity date, that specific date. But American option is like you can exercise the option throughout some periods, right? And Asian option is like the conditional on the average price, right? Average price of your asset you can exercise or not. Okay. Now let's move down to our building block concept over here. Call option, and put option, right? An option, what is this? It's a right to exercise or not. It's my right. As long as you are option buyer, you hold the option, then it is your right, your choice, whether to exercise it or not. Only when it, maximizes your utility or it is beneficial to you, you exercise it. If it is not beneficial to you, you choose not to exercise. Just move on, right? Of course, you spent your money to buy that right. That's, the initial price that you have to pay, but you don't have an obligation to exercise that right, okay, if it is not beneficial, advantageous to you. So it gives you, right, some kind of a protection, That's an important feature of these options. And then there is inevitably probabilities, right, involved with it in pricing these options. Now, right, this is the right, not the obligation to buy or sell a given quantity of an asset in the future. This asset is called underlying asset or reference asset, right? Depending on the context, they name it differently. By the way, you see a lot of different jargons in finance. Why? Do you have a lot of jargons? Because finance is really a simple world. So much so that you want to tease out something interesting and spook some different people, right? Who is new to finance. But in the end, we are talking about similar things, right? So jargons, you have to familiarize those things. Anyway, and then the future at the prices agreed upon today. That price that you agreed upon today, right, is called exercise price or strike price. Yeah, again, two jargons meaning the same thing. Don't get spooked out, right? Exercise price or strike price. Anyway, and then call option versus put option. Call is about right to buy. Put is about right to sell. So it's a contract between you and your counterparty, right? So one guy can write a call option to you, and then write a call option. That means sell a call option to you, and then you should be the buying call option, right? It's like a kind of a betting between you and your counterparty, okay? And then it's a right to buy, not the obligation, at a certain strike price in the future, right? Put option is the right to sell, okay, right to sell. Well, for call option, right, if you buy the call option, then if the underlying asset price goes up, then you are in the money. You know, it's your party time, right? If the underlying asset price goes down, you just forego, right? Don't exercise anything, right? But put option is the other way around, right? When the asset price goes down, you have the right to sell this asset at a higher strike price, okay? So you will party when the asset price goes down. In contrast, when the asset price goes up, you just forego, okay? Don't exercise your right or anything, right? Now, from company manager's perspective, why would you need currency options? Imagine yourself as the CFO of Hyundai Motors. Let's say you successfully exported as much as 1 billion euros worth of cars to European dealers. Okay, lump sum. Wow, you're happy, huh? Would you be happy 100% only? Still, something may bother you so that you may be awake at night. What would you be worried about? Well, what if the euro value depreciates over time before you receive that money? Oh, okay, right? For that part, you need some downside protection, okay? You have to sell euro for current value instead of 1 month from now, okay? Put option may help you in that sense, right? Yeah, so put option may work for you in this case. Why not just do forward contract for futures? You may wonder. Forward or futures only lock in the FX rate, okay? It's not a right, but you have to. It's an obligation that you have to transact at that fixed price. Whereas put option guarantees that the value of euro will not be less than the strike price, while allowing the company to benefit from any favorable FX movement, right? So you need to pay the insurance premium upfront in this case. Like, I'm interpreting this put option as an insurance, right? So the put option price works it that way. Now, let's take the other perspective about why you need currency options as company managers. Let's say you are the CFO of Hansung Motors this time. Foreign students may be, feeling strange. What is Hansung Motors? You've never heard about it. Of course you've not, but that's because this is an importer, right? They are importing Mercedes-Benz to Korea. So you must have not have heard of it before, right? But let's say, Benz was, Benz has been perhaps the most popular car sold in Korea these days, right? and then you got successful, so you're selling so many cars so that you're supposed to pay 100 million euro next month to Benz in Germany, right? As an importer, you have to pay them, right? You made a promise. Then what would keep you awake at night? Okay? What if euro value goes up too much? Appreciate this time, right? You have to buy euro with Korean won, right? Can you secure cheaply? Call option would save you, right? That's the idea. So why not just do forward contract or futures, you may wonder. But forward or futures only lock in the FX rate, right? Call option guarantees that the value of euro will not be more than the strike price, while allowing the company to benefit from any favorable FX movements. You need to pay the insurance premium upfront. Well, I'm interpreting this call option as kind of an insurance over here. So that's that. Option contracts, preliminaries, well, European versus American options are there. European options can only be exercised on the expiration date, one day, while American options can be exercised at any time up to and including the expiration date, right? So CEOs, right, in companies, right, publicly traded companies, they receive call options, and the thing is, it's how long is it? Like 8 years length or 7 years length, and then initial 3 to 5 years they cannot exercise it, but the remaining 3 years or something, they are vested. We call it, the CEO's call option is vested to them, vested into their jacket, so that their bullet is over there. They can shoot from then on over the 3 years. They can exercise it over that 3 years, final 3 years. So CEO's option payment is more like American option, but the way we deal with over here, those options that we talk about over here, is more like European option, right? The option valuation technique is developed using European call option and put option framework, because it's easier, right, to model that. American options are usually worth more than European options, other things being equal. Why American option is more valuable than European options with similar features? Let's say same maturity or same expiration date and the same strike price and things like that. Why American option is more expensive? Because it's more valuable. It gives you more flexibility or more right. Because European option, you can exercise the right only in the final day, one day, whereas American option, you have that right over multiple days, right? Many more rights. Okay, so that's why. Moneyness, right? If immediate exercise is profitable, option is in the money. Out of the money options can still have value. Why? Thanks to the uncertainty. And at the money, we're going to get to that out of the money issue a little later. And then at the money, well, that's when the current price is equal to the exercise price or strike price, the same thing we're talking about. And then representing exercise price, we use the big E, and then strike price, if you like it that better, then K, we show it that way. Anyway, let's go back over here. Out of the money options, right? For this part, I need to go to a diagram later on, right? Diagram later on. Out of the money option at the expiration date, its value is 0. But before the expiration date, the out of the money option is not completely value 0 at all. it is slightly positive, right? Even if you're deep out of money, the price is always something positive. Why? Because there is a slight chance, right? There's always a chance that extreme other event may happen, so that you may end up with in the money. That's why uncertainty or the risk becomes your friend. Okay, we're going to talk about that a handful of slides later. Wait for that. And then Philadelphia Stock Exchange currency options specification is shown over here. And then you see NASDAQ OMX Group took over Philadelphia Exchange in 2008. And then organized exchange for option trading versus OTC is there for you in option market. And then it turns out the over-the-counter market is much bigger in size. And its currency options are primarily traded in the over-the-counter market. Minimum trade size is greater than or equal to $1 million US, right? Average daily over-the-counter trading volume is $294 billion in 2019. And then typically European style options are traded over there. And currency and the contract size for different currencies are shown over here. Australian dollar, 10,000 Australian dollar unit. British pound, 10,000, and Canadian dollar, euro, Japanese yen, New Zealand dollar, and then Swiss franc. Those contract sizes are there. Okay, quite standardized products in that can be traded in the exchange, open exchange like this, right? And basic options pricing relations at expiry, or on the day of expiration. Date of expiration, what happens? At expiry, an American option is worth the same as European option with the same characteristics, all right? If the call option is in the money, it is worth what? The, I should say, spot price minus exercise price, right? Spot rate of maturity date, S sub big T, means spot exchange rate on the maturity date, minus E, exercise price, right? If the call is out of the money, it is worthless, 0. And the thing is, it's a right that you can choose whichever is favorable to you. So the value of this call option on the expiration date is maximum function. Whichever is higher, you choose for that, right? Maximum, go for that, right? That's the idea. So we have maximum between these two, strike price minus exercise price, or 0. You choose not to exercise. In the money situation, out of the money situation, you never know what's going to happen. Whichever favorable to you. If the put is in the money, it is worth what? Exercise price minus spot price at big T, that is maturity date. If the put is out of the money, it is worthless, which means 0. Now, the value of put, okay, on the expiration date should be, again, maximum function of these two. Make sense? Right. And then, what do you mean by A and E? E is European option. And then A means American option. Hey, Andy, didn't you say American option is more valuable than European option? Yeah, that's before expiration date. Okay, on the expiration date, right? To the extent that you have not exercised the right of American option until the expiration date. On that expiration date, it is, essentially the same as European option on the expiration date. It is different from European option before the expiration date, but on that expiration date, it's identical. That's what it is about. Okay, now currency futures options. CME Group trades American style options in most of the currency futures contracts and European style options as well. And then underlying asset over here, you see the difference over here in this slide. I inserted one word over here, futures. Before it was currency options. Here it's about currency futures options, right? Underlying asset is a futures contract on the FX, right? Before it was underlying asset was FX itself, spot rate, okay? But here is about futures rate. Now, the FX, not the physical currency, okay? It's based on futures. Futures is the underlying asset over here. One futures contract underlies one options contract, right? And then expirations in March, June, September, and December, and 3 additional months are there. And then options on currency futures behave similar to currency options because the future price converges to the spot price as the futures contract nears maturity, right? Futures price right now, if you have 3 months down the road, the price, the current spot exchange rate may be different from the forward or futures rate, right? But as you get closer and closer to the maturity, the spot price and then the futures, they have to converge. Currency futures options. So when a call futures option is exercised, the holder acquires 2 things. 1, a long position in the futures contract, and 2, a cash amount equal to the exercise of the futures price over the strike price. On the other hand, when a put futures option is exercised, the holder acquires. Wait, currency options, futures versus currency options, right? The same strike price and the same maturity. The payoff from a European call option with a strike price K is maximum function of big S sub big T minus K and 0. Where this S of big T is the spot price at the option's maturity. That's currency option, right? The payoff from a European futures call option with the same strike price is maximum function of big S sub big T minus big K and 0, where big F sub big T is the futures price at the option's maturity. Futures, right? If the maturity of the futures contract and that of the option are the same, then S equals F, and the 2 options are, in theory, the same, all right? Now, why is currency futures options rather than currency option itself? Well, it's kind of analogous to this. Crude oil versus crude oil futures. Which is easier to invest from your perspective as a investors, bankers, right? To buy and sell crude oil, you need oil tankers and then all these kind of facilities, right? 유류고 kind of, But buying and selling oil futures, what you need is this trading desk only, which is easier. Make sense? So likewise, the currency itself, right? Currency futures is a lot easier for you to trade. Futures contract is more liquid and easier to trade than the underlying asset. Futures price is known immediately from trading on the futures exchange. Spot price of the underlying asset may not be readily available, but like derivatives like futures and forward help price discovery in the market, right? It's the underlying asset itself, or even the non-future spot market materials, right? There may be less liquidity, so that the price may be inaccurate. But whereas in futures market, it's liquidly traded, whereas the information is reflected in real time, much more efficient. So futures works this way, helping our price discovery. And then exercising a futures option does not lead to delivery of the underlying asset. Futures contract gets closed out before delivery, and then lower transaction cost for futures options than for currency options. Now, basic call option and put option profits and payoff diagram looks like this. What you see is in the red line over here, the hockey stick like, right? This is a call option. If you're long position of one call, then you get your payoff on the day of maturity or the expiration date will look like this, right? What you see in your horizontal axis, x-axis is the spot rate, okay, or spot price of the underlying asset on that expiration date. What you see on your vertical axis is the profit versus loss over here. This is 0. And then call option, well, it's kinked line like this. Originally it starts from over here, exactly on your horizontal axis like this, right? So much, and then it kinks from the exercise price. So why is that the case? Well, if the underlying asset is cheaper than your exercise price, what do? You simply choose not to exercise your option, right? So forego. Whereas if the spot price is bigger than the exercise price, you exercise it and then buy it at the exercise price and turn around and sell it at the spot market, okay? And make a profit out of it. So this diagram will look like this originally. Is 45 degrees line kinked at the exercise price, 45, 1-for-1 matching. Not just 1-for-1, but the same magnitude over here. Now, why is it shifted downwards? Because you have to spend some money to buy that call option from the option writer, right? The counterparty, right? So that's why your payoff is shifted downwards as much as what you paid as a call option price. And then it goes like this. So if you keep it unexercised at this point, right? If it is out of the money and you choose not to exercise it, what you lose is the initial purchase price of your call option. Okay, this is your loss, a little bit. And then exercise price, you're still, even if you exercise it, up to a certain point of break-even point, you will be in a loss position, right? But after this break-even point, you will make money. The profit is positive, right? That's what this diagram tells you. And what's that break-even point? That's exercise price plus your call option price, the initial purchase price of call, okay? In contrast, the call option writer's diagram looks like the blue lines. It's positive over here because they sold it and you did not exercise it, so they don't have to pay anything to you. But as you exercise it, your gain will be their loss. Zero-sum game. If you add these two lines, it will be like 0, right? And like this. So that's what here it is talking about. Out of the money, in the money. Deep out of money, deep in the money. And at the money, usually at the money situation is like over here. But what's the break-even point? Over here, they say it. The at the money situation, the researchers have been loosely calling it around here, at the money, the strike price nearby. Anyway, consider a call option on 10,000 euros. The option premium is 25 cents per euro, and then the exercise price is $1.5 per euro. Right, $1.5 per euro. The option cost 2,500 today because you multiply this guy by 10,000 euro, and then option cost, right, 2,500, and the break-even exchange rate is simply the exercise price plus the option premium. which is $1.75 per euro. Okay, now how about put option? Right, the diagram looks like this. Oh, okay, compare this one with that one. Okay, it's downward sloping starting from 0 to exercise price, and then afterwards it is horizontal. Why? Well, if this is a right to sell, right to sell the underlying asset. Okay, if the spot market price of the asset is bigger than the exercise price, you just don't exercise it. You exercise this put option only when it is favorable to you, which is the spot price is lower than the exercise price. You can, at this point, right, you can sell your commodity or currency at higher price. Okay, sell high. That's why. Now, if the put option is in the money, which is over here, in the money, and out of the money over there, in the money, it is worth E minus S of T. E, right? E minus S of T. So S of T will be here. And then the maximum gain should be exercise price minus put option price over here. Initial purchase price of your put option is like this. Just like the call option discussion, the graph is shifted downwards for the put option buyers because you had to spend some money to buy that option. Okay, if the put is out of the money, it is worthless, and the buyer of the put loses his entire investment of P0. That's over here. Okay, consider a put option 10,000 euro. The option premium is 15 cents per euro. Then the exercise price is $1.5 per euro, right? And at what exchange rate do you break even? That's 1.5 minus the transaction cost, which is 15 cents. That's 1.35 per euro. That's where this is about. 1.5 versus 1.35. Okay, that's this part. What is the premium or the maximum gain on this put option? Well, that maximum you can calculate because this is over here. Okay, it's capped, right? The put option possible maximum profit is limited over there. Let's say so maximum gain over here is 1.5 minus your put option price that purchased, 1.5 minus 15 cents times the euro amount, 10,000 euro. So it gives you $13,500. Okay, that's this guy. Now I said put option, its profit is limited. Okay, in contrast, call option is, in theory, the profit of potential profit, possible profit of call option can be unlimited. It can go like infinity, right? Good. So that's the contrast. Now, the market value, time value, and intrinsic value for an American call option. Well, the red line over here in the diagram shows the payoff at maturity, not profit, of a call option. Okay, payoff, right? Not profit. So we are not considering the transaction cost, initial purchase price of your call option. Only the payoff, right? You see the profit if you are in the money, right? And then the intrinsic value of your call option will be like this, okay? And note that even an out of the money option has value before maturity, okay? Let's say this is a 3D diagram. Let me draw this one more line, which is time. Okay, then your maturity is over here, and then you have about 1 month left, and then you are out of the money right now. Okay, 1 month ahead of maturity, right? And T, 3D picture you can think about over here. So that, so that on the day of maturity, what will happen? Well, you can similarly draw this horizontal graph like this, and then I will run it parallelly over here, okay? And then I will change the color of this graph to this with some different thickness. So on the maturity date or expiration date, it'll be like this. You will not exercise the call option if it is out of the money. But if it is in the money, what would you do? You will exercise, and then the payoff will be like a 45 degrees line, just parallel to what you see over here. Parallel, okay? 45 degrees line on the maturity date. But 1 month before, what would be the value of your call option? It will be like a green curve over here, smooth line. And by the way, this is a bit misleading over here. The green line should be above this orange line over here. And it's going to be a smooth pasting one, like peanut butter, you paste it. Anyway, like this. The question is, why should it be slightly positive over here? Why shouldn't this be 0? Well, that's because there's an uncertainty. Let me change the color over here. So you stand over here, right? Out of the money, but there is always a possibility that this asset could end up in the money by the time reaches to the maturity. I'm drawing a 3D graph, like moving like, that direction to the other direction. More uncertainty, well, more value to this option. More higher risk. If the asset has higher chance of ending up anywhere, like going extreme, like GameStop stocks, right? Then the option value right now will be higher. The risk will be your friend, okay? That's this story over here. With an American option, you can do everything that you can do with a European option, and you can exercise before expiry. This option to exercise early has value. Thus, call option value of American style will be bigger than or equal to European call option. Put option the same way. Okay, that's the important message here. So I hope you enjoyed this lecture part, and then the next video I'm going to discuss some economic basics about risk neutrality, and then talk about some mathematical basics to digest the following videos. Okay, so thanks for watching, and like and subscribe. Thank you.